Welcome to today's deep dive. So we've got a stack of recent white papers on distributed ledger technology, or DLT. And our mission today is to figure out how it's fundamentally rewiring capital markets.
Yeah, it's completely replacing those slow, risky legacy settlements with something entirely new.
Right. Think about traditional T+1 or T+2 settlement delays. It's basically like buying something online and just, hoping the seller actually mails it to you after you pay.
Which is, frankly, terrifying when you're dealing with millions of dollars.
Exactly. Yeah. But DLT is more like handing a friend cash for a physical ticket. It's simultaneous.
And the stakes for getting that right are massive. Those legacy gaps create what we call principal risk.
Right.
And to protect against that risk, institutions are forced to tie up literally billions of dollars in clearinghouse collateral. But DLT eliminates this entirely. It turns the assets like corporate bonds and the money into tokens on a shared ledger.
And when we say money, we aren't talking about volatile crypto here, right?
Oh, no, not at all. The focus in these sources is entirely on WCBDCs, or wholesale central bank digital currencies. They act as the programmable money.
Okay, so how do we guarantee that simultaneous handoff in institutional finance? Like, how do we make sure both sides actually swap at the exact same time without some massive clearinghouse playing referee?
Well, that's done through a mechanism called atomic delivery versus payment, or atomic DVP.
Atomic DVP, got it.
Right. It's basically an all-or-nothing cryptographic smart contract swap. And it takes less than 2 seconds to execute.
Wow, under 2 seconds.
Less than 2 seconds. And it reduces settlement risk to absolutely zero, which means those massive clearinghouse margin requirements, they just disappear.
That's huge.
It really is. Like, imagine an institutional asset manager buying $20 million in tokenized corporate bonds from an investment bank.
Okay.
Traditionally, they'd post overnight margin and just pray the bank doesn't fail before Tuesday. But with DLT, it happens instantly.
Okay, let's unpack this. If it's truly an atomic, all-or-nothing swap, does that mean if one side fails, the whole deal just evaporates rather than leaving someone empty-handed?
Yeah, exactly. Which sounds chaotic, I know.
Yeah, a little bit.
But think about the alternative. The smart contract mathematically cannot execute unless both sides are present. So if the bonds aren't in the investment bank's wallet, the WCBDCs never leave the asset manager's possession.
Oh, I see. So you might have to retrade the next day, but your $20 million isn't trapped in some messy bankruptcy proceeding.
Exactly. You drop your settlement risk to literal zero.
So that fixes the domestic asset swaps beautifully.
Yeah.
But what happens when trades cross borders in time zones?
Well, for that, you need a parallel framework called payment versus payment, or PVP.
PVP, okay.
Yeah, and this solves what's called Herstatt risk. That's named after a German bank that actually failed back in the 70s while holding counterparties' funds across overlapping operating hours.
Right, because legacy FX systems force you to wait for localized networks like Fedwire to open, right?
Exactly. But DLT uses multi-CBDC networks for real-time swaps. 24/7, 365, no correspondent bank cutoffs.
Because traditional cross-border trading is, it's basically like a really stressful relay race. You pass the baton, but the next runner is literally asleep in another time zone.
That's a great way to put it.
You're just carrying that currency exposure for hours, waiting for their local banking system to wake up. But with DLT, you mathematically lock both currencies at once.
Right. Let's look at a specific scenario from the white papers. Say a commercial bank in Tokyo is swapping 1 billion Japanese yen for US dollars at 10 p.m. on a Sunday, Tokyo time.
Okay, so normally they'd be stuck waiting for Western systems to wake up on Monday morning.
Exactly. Carrying risk in the dark for hours. But with DLT TVP, they use multi-currency sovereign ledgers. The Japanese bank locks their tokenized yen, the US bank locks their WCBDC dollars, and boom, the protocol releases both simultaneously.
Real-time finality on a Sunday night. That is incredible.
It completely removes the correspondent bank cutoffs.
So why should you care about all this deep plumbing of institutional finance? Because capital markets are fundamentally abandoning multi-layered custodians in favor of single shared ledgers.
Yep, completely.
Capital that used to be locked up as defensive margin is being freed up instantly. It's dropping systemic transaction costs from astronomically high to absolutely minimal.
Which is a massive structural shift. And honestly, this raises an important question.
Oh.
If DLT smart contracts natively provide zero risk, instant settlement, what is the future survival of the massive multi-layered clearinghouses and registries that currently dominate global finance?